Now, Taylor Wimpey, one of the UK's largest home builders, just reported first-half numbers. The company cited poor weather in the first quarter affecting revenue, but it confirms that it will remain on track to deliver on 2018 expectations. Joining us now for an exclusive interview is the CEO, Peter Redfern. Great to see you and have you on set with us here, Peter. Good morning to you. So how are you expecting to deliver on those 2018 expectations?
I think, from here, we don't see it as a particularly sort of difficult challenge. 2017 was a record year in every respect. And we still expect 2018 to be higher on revenue, higher on volumes, higher on margins, but by relatively small amounts, but still to show positive progress. First half of the year is relatively flat, but as I say, we sort of knew that, and so no great surprise. So if you look at where our order book sits, which is ahead of this time last year, and we can obviously see the margins and performance in that, and where sales and build are, the weather issues that we saw back in March, really we've managed to catch up on during the second quarter. So we feel pretty comfortable sat here looking at 2018 as a whole.
Yeah. One thing that's making, I guess, quite a lot of people, at least in London, uncomfortable is the fact that house prices have been under pressure this year. Is there still underlying demand for new build homes? How strong is that?
Very much. So again, if you look this year compared to last year, 2017 was a record sales rates in every way, and our sales rates in July 2018 are level with 2017. The first half we were about 3% behind, so overall still a very, very strong set of market conditions for new build homes. But obviously we can't ignore consumer confidence as we look at the next sort of 18 months. So it's not without any risk, but actually today, if you look at all of our statistics and performance out in the field, it's very, very good.
But how much of an impact could we get if we have policy tightening from the Bank of England? I mean, we are expecting a rate rise this week, for example.
I think so, but I think, if we're talking about, and we've talked about this before, we did before the first rate rise that now feels a long time ago, sort of a quarter point rise, a small rise in the context of when it's been well signalled doesn't particularly concern us. The impact on sort of average mortgages is probably only sort of £25 to £30 a month. It's not particularly huge at a point when mortgage availability is good, and actually mortgages themselves are very affordable. I think that the bit that we do, as I say, have to be more conscious of is just the general confidence in the consumer. I don't think it's about, for us certainly, about that sort of about a rate rise. It's just about what's going on politically and economically in the UK in a wider sense.
Do you expect the weakness in London to spread to the rest of the UK?
I don't think we do, but, and if you look particularly, the weakness in London has been centred around the upper end of the market with a very different set of buyers. There's been various impacts that have actually helped other buyers around stamp duty that have hindered those sort of prime central London buyers. So I think we see quite a de-linked market between that prime central London market and the wider UK. I go back to, sort of for the majority of our purchases, for the ordinary purchases across the UK as a whole, it's a combination of confidence and mortgage cost and availability. The latter remains very good. The former is, sort of a little bit less solid than it was maybe a year ago.
You mentioned political uncertainty earlier. How much of an impact could Brexit have to the downside on house prices?
I think, sort of in a direct sense, the impacts on our business as a whole are actually quite muted. We're a very UK-centric business, so, sort of imports, resources, those sorts of things actually don't affect us directly. I think the unknowable is a wider confidence and, sort of economic issue. Obviously, from an interest rate point of view, that's more likely to keep interest rates low for longer, and that's the single biggest impact on our customers in the long term. But, in terms of confidence in the short term, it's very hard to call.
Right, OK. And I've heard that you wanted to sort of back off a little bit from central London. What's the progress on that?
I don't think that quite fairly reflects it. We have a good business in central London. We bought two large sites last year in central London as after the market had changed, because we saw good land opportunities. We see that as a long-term place that we want to be. Inevitably, it's going to be a slightly smaller business in the short term, but for us, it's not an enormous part of what we do, so we can afford to take a longer stance on it and remain there. We have a very good team, we have good assets, and sort of trade through a more difficult set of short-term conditions. That creates opportunities as well as risks.
You, along with some of your competitors, are one of the worst performing stocks on the FTSE 100 year to date. What defines you from some of your other competitors that might mean investors would pick you over them?
I think what we're focused on, and we'll talk about this a lot today and did back in May when we did a Capital Markets Day, is really getting under the skin of every part of our business and modernising, changing it in a more creative and proactive way. We're doing an awful lot with our customers. We think in the long term that will help sales rates and pricing, and we're doing a lot about the efficiency of the business and how it operates. We've had a very, very strong set of performance over a number of years. If we want to go further, we have to really be prepared to challenge ourselves internally, and I think we're far more prepared to do that than anybody else in the industry.